The Bank of Botswana has raised its monetary policy rate by 200 basis points in April 2026. That is the largest single adjustment in recent memory. This edition of the Capital Brief breaks down what that decision actually means and what does it not solve. Firstly, some context. The Monetary Policy Committee moved the rate from 3.50% to 5.5%. There's a cumulative increase of about 200 basis points since the last increase, and there's about 360 basis points since August of 2024 low. The bank called it a recalibration, not tightening. That distinction matters, and we'll explain why. Here are the key numbers that you need to know. The monetary policy rate now sits at 5.5%. The consumer price index reached 4.21% in March of 2026. Forex reserves stand at 47.4 billion Pula, covering approximately 6 months of imports. The government faces a budget deficit of 26.4 billion for the 2026-2027 fiscal year, which is 7.6% of GDP. The Botswana Stock Exchange Domestic Companies Index closed the past 12 months up 9.9%. So what is the bank actually doing? The monetary policy rate increase is not conventional tightening. The bank said so directly. The problem is structural. Botswana's banking system has a liquidity imbalance. Some banks hold excess deposits while others run short. That imbalance was pushing short-term market rates away from the monetary policy rate, weakening the bank's ability to signal policy. Raising the anchor rate while extending the repo maturity to 3 months gives the system a longer runway. The LPR directive is the part most people missed. Commercial banks have been directed not to pass this increase on through higher lending rates. Your mortgage should hold, your business loan rate should hold for now. But here's the risk that is not in the headline. The prime lending rate directive is guidance, not law. Some banks were already widening margins above prime before this announcement. The Bank of Botswana flagged this in the February 2026 monetary policy statement. If structural liquidity pressure persists, and it will, because it is driven by the diamond downturn and the fiscal pressures that no rate decision fixes, banks will not raise the headline rate. They will quietly tighten credit access instead. Fewer approvals, slower processing, higher deposit requirements. The rate holds, but the credit market shrinks. What should you actually be watching? 3 signals. Firstly, whether interbank rates coverage towards the monetary policy rate over the next 60 days rather than drifting of the corridor ceiling. Secondly, whether all commercial banks hold prime lending rates flat through June 2026. And then thirdly, whether forex reserves stabilize at or above 6 months of import cover. These 3 indicators will tell you whether this decision is working as intended. The bigger picture is that monetary policy is buying time. The fiscal deficit, the diamond revenue decline, and the absence of sufficient export earning alternatives are not interest rate problems. The second transformation conversation, which is building sectors that earn foreign exchange competitively, is the long answer. Whether structural reforms move fast enough to make use of the time being bought is the question that matters most going in the second half of 2026. This has been the Capital Brief, Edition 1, Economic Intelligence for Botswana. Each edition covers this week's most important policy signal, which separates sections for business owners, finance professionals, analysts, and the broader public. If you found this insightful, kindly subscribe to the Capital Brief at www.thecapitalbw.com. Weekly, real data, no jargon that gets lost in the room. My name is Chilo Ketlhoafetse. We'll see you again in the next session.